Welcome to The Explainer. Today, we need to talk about a ticking time bomb in the financial world, and it's set to go off right around 2026. See, there's this new kind of risk out there, and it is changing all the rules for investors, for business owners, and the crazy part? It's hiding in plain sight. For years, the playbook for financial safety was, well, it was pretty simple, right? Own valuable stuff, keep your debt low, and you're golden. But what if I told you that very playbook, the one we all trusted, is now dangerously outdated, and that following it could lead you straight into a trap? I mean, we were all taught this simple equation. You build this fortress-like balance sheet, and that's supposed to be your ultimate shield against any financial storm. It was basically the gospel of smart, conservative investing. But here's the thing. The game has totally changed. That era of cheap, easy money, the one that let everyone just roll over their loans without a second thought, it's over. It's gone. And because of that, the biggest threat to your capital, well, it's not what you think it is anymore. Okay, so let's really dive into what this paradigm shift is all about. We're talking about a move from a world where asset value is king to a brand new world where something much more immediate, much more dynamic is calling all the shots. Yeah, forget about bad assets. The new keyword, the one you need to burn into your brain, is timing. Seriously, most of the financial failures we're seeing right now, they're not happening because the assets are worthless. Nope. They're failing because of timing. It all comes down to not having cash at the exact moment you desperately need it. So what is this liquidity risk anyway? Why has it suddenly become the most critical thing for anyone with capital on the line? All right, let's break it down. Okay, in the simplest terms, it's the classic asset-rich, cash-poor nightmare, but on steroids and happening at the worst possible moment. It's when you can't get your hands on cash, when you absolutely need it to pay your debts, even though your portfolio is theoretically worth a fortune on paper. And this is where it gets really interesting, because this problem actually has two different faces. Think of it this way. On one side, you've got funding risk. The question there is, can you even get cash? Can you get a new loan? Then on the other side, you have market risk. And the question there is, okay, can you sell your asset to pay off the old loan? It's not enough to solve one, you have to be protected from both. And all this leads us to what is probably the most common and, frankly, the most dangerous mistake that even really sophisticated borrowers are making right now. And that's confusing two very, very different concepts. This quote it nails it. Think about it. Leverage measures what you owe, but liquidity, that determines whether you can actually pay. Leverage is like a static photo of your balance sheet, a snapshot in time. But liquidity, that's the live streaming video of your ability to survive when the bills actually come knocking. And this really breaks it down, doesn't it? Leverage is a static snapshot. It's focused on the balance sheet, asking, what do I owe? But liquidity is dynamic. It's all about cash flow and market access, and it asks the only question that matters, can I pay or refinance right now? See the difference? One is history. The other is your immediate survival. So, because of this fundamental shift in risk, you better believe lenders have completely thrown out their old playbook. They are looking at your portfolio through an entirely new lens now. Yeah, lenders are no longer impressed by the theoretical value of your assets. They're now underwriting what you could call the liquidity stress of the exit. They're laser-focused on just one thing. How quickly and how certainly can we get our money back if things go south? For them, it is all about their exit. And you can see exactly how they're doing it. They're systematically pricing this new risk into every single deal using four key levers. First, wider spreads. If your asset is hard to sell, guess what? You're going to pay a higher interest rate. Second, tighter covenants. They're demanding more frequent stress tests to get an early warning if you're heading for a cash crunch. Third, shorter tenors. And finally, number 4, higher equity. They want more of your cash in the deal from day one. It's a whole new ballgame. And this chart, this perfectly illustrates the illiquid trophy asset problem. Look, an asset, say a prime office building in a major city, can be incredibly valuable on paper. But if nobody is actually buying those buildings right now, if the transaction volume has just collapsed, that asset is practically worthless if you need cash today. You're completely trapped. Okay, so now that we understand the problem, we get the new rules of the game, what can you actually do about it? How do you protect yourself and your portfolio in this new environment? All right, here are your new disciplines. This is the essential survival guide. Number one, you have to stress test your exit timing, not just the asset's value. Don't just ask, what if my asset's value drops? You need to ask, what if it takes me 2 years to sell this thing instead of 6 months? Number two, align your loan's term directly with how liquid your asset actually is. Number three, maintain a dedicated liquidity reserve. And number four, diversify your funding sources. In this new world, these disciplines, they're not optional anymore, they're essential. And really, if you take away only one thing from this whole discussion, let it be this. Leverage is negotiable. Liquidity is not. Think about it. You can argue with a bank about your interest rate. You can try to negotiate loan terms. But you cannot, under any circumstances, negotiate with a market that is frozen solid. It's not negotiable. So that leaves you with a critical question to ask yourself. Is your strategy built for yesterday's market or for tomorrow's? The answer to that question is going to determine not just your returns, but your very survival in the years ahead. Because in this new credit paradigm, liquidity isn't just king, it's the only thing that keeps you in the game.